Hey there, so on Friday, a so-called SEA counterpart of SoFi, a company called Grab, shot up over 8% in a single day on massive volume. And the question everyone's asking is why? Well, the data I'm about to show you suggests the big money, the institutional players, were quietly getting into position before this price explosion ever happened. Look, if you just hate the idea of listening to a random guy hiding his face on a tiny channel, here is the single most important takeaway. Friday's move wasn't about a single piece of news. It was the result of a fundamental story getting stronger and stronger over the last few months, finally meeting a wave of market momentum. The technicals are strongly supporting the trend, but after such a strong breakout, there's always a catch. So, stick around if you want a detailed breakdown of its story and technical picture. Alright, for those of you who are new to the channel, my name is DataCat, and well, I'm not really a big fan of doing these introductions. I spent a number of years as an analyst inside a big Fortune 50 company, the corporate grind, basically staring at spreadsheets until I ran out of coffee. I traded that life for this one because I genuinely believe the kind of data that Wall Street uses shouldn't be some big secret. So this channel is my attempt to unpack it and share it with you. It's been about 2 months now and I really appreciate you being here. If you find this kind of deep dive valuable, hitting that subscribe button would be a huge help. Okay, so let's get into Grab. To understand what happened on Friday, you can't just look at Friday. You have to look at the entire year, 2025. The company has been quietly delivering. They've been consistently beating expectations. In the first quarter, they beat on revenue. Then in the second quarter, revenue was up around 23% compared to the year before. But here's the part that really matters. They swung from a loss to a net profit of $35 million. That's a huge deal. It's one thing to grow, it's another thing entirely to grow and actually make money. It shows the business has real operating leverage. They also added 2 million monthly active users, bringing the total to 46 million. So, more people are using the app, and Grab is getting better at, grabbing money from each transaction. It's like leaving a bowl of food out for a stray cat. At first, it's just happy to eat. Eventually, it decides it owns your house and starts demanding the good stuff, the wet food. That's operating leverage. Now, this profitability isn't just coming from their ride-hailing and delivery services. That's the foundation. Their dominance in major cities gives them a huge advantage. But the really exciting part of the story, the part that adds a whole other layer to the valuation, is their fintech arm. They're building this whole financial ecosystem with payments, wallets, and even lending for their drivers and merchants. And they've launched actual very first digital banks. GXS in Singapore and GX Bank in Malaysia. This means they're tapping into a region with a rapidly growing middle class, where financial services are still pretty underpenetrated. It's a long game, and they have to be careful with managing credit risk, but if they get it right, the potential to increase how much money they make per user is enormous. And then, just to add another log to the fire, they announced a partnership with WeRide. This is the autonomous vehicle part of the story. Now, let's be clear, you're not going to be hailing a robot grab car tomorrow. This is a medium-term catalyst, but it gives them a credible path toward a future where they can dramatically lower the cost of each trip and boost their margins. For investors, it adds this powerful platform plus tech narrative. It tells them this isn't just a taxi company, it's a technology company shaping the future of mobility in Southeast Asia. So you have this backdrop, right? Strong earnings, a profitable quarter, a huge fintech opportunity, and a futuristic AV story. The analysts who cover the stock are seeing this. Most of them have buy ratings on it, with price targets clustered around the mid-$6 range, and some even see it going as high as $8. This brings us to the market chatter. There was a noticeable build-up of talk on trading blogs and forums about short interest in Grab leading into last week. When you have a stock with a solid fundamental story that a lot of people are betting against, it can create a coiled spring. All you need is a little push to set it off, and that push came last week. There was no big press release from Grab on Friday. The move was driven by follow-through. The market was still digesting that great second quarter earnings report and the WeRide partnership. And on top of that, it was just a risk-on week for the broader market, meaning investors were feeling a bit more adventurous. All these factors came together and boom, there you go, the spring uncoiled. You'll sometimes hear people call Grab the next SoFi or the SoFi of Southeast Asia. And I get it. On the surface, there are similarities. They're both trying to build a financial super app on top of a strong consumer brand. But it's a lazy comparison, and it's important you understand the differences. SoFi is fundamentally a US bank. Its profits are tied to lending and interest rates. Grab is a transaction-based business in Southeast Asia. Its profits are tied to take rates, user frequency, and a whole different set of economic and competitive dynamics. It's like comparing a house cat to a lion. They're both felines, sure, but they live in completely different jungles and hunt completely different prey. Understanding that distinction is key. Now, you should be able to tell that the bull case is pretty clear. If Grab can keep growing revenue in the 20% range, keep improving margins, and start to really monetize that massive fintech opportunity, the stock has a lot of room to run. The WeRide deal is the cherry on top, a long-term story that could justify a much higher valuation down the road. So that's the fundamental story, that's the why behind the move. But to really get the full picture, you have to look at the charts. You have to see what the price and the volume were doing, because that tells you how it happened and what the big money was thinking before the rest of us. Before this massive jump on Friday, if you look at the data over the last 3 months, something interesting was happening. It was quiet, the stock was trading sideways, not really going anywhere. But underneath the surface, it looks like the smart money, the large institutions, were quietly building their positions. The data shows a clear accumulation trend. The institutional flow score was a 70, which is quite high, and the money flow trend was positive. What this means, in plain English, is that big players were buying up shares, but they were doing it carefully, absorbing all the available shares for sale without causing a big price spike that would alert everyone else. It's like a cat patiently, silently stalking a bird. You don't see the big pounce yet, just the slow, deliberate positioning. And the underlying health of the stock's trend was improving dramatically during this quiet period. The moving average alignment score was a perfect 100. That tells you the short, medium, and long-term trends were all stacked up in a perfect bullish formation. The Ichimoku cloud, another indicator we use, was also bullish. So while it looked like nothing was happening, the foundation for a big move was being built, brick by brick. And then came Friday, the long-awaited pounce. This wasn't just a small jump, it was a textbook institutional breakout. The stock gained 8.5% in a single day, on volume that was over 3 times its 20-day average. That kind of high-conviction move isn't driven by your average retail investor. That's a major market event. The candle was a gap and go. It opened higher than the previous day's high and just never looked back, closing right near the top of its range for the day and hitting a new 52-week high. It just completely shattered all the recent resistance levels. $5.29, $5.43, $5.52, all in one session. It was a statement. Now, this is where you have to be careful. What now? This explosive move has left the stock in what we call a stretched or overbought condition. It suggests that, a period of rest might be coming soon. Both the daily RSI and MFI is at around 80, signaling deep in overbought territory. Now, strong stocks can stay overbought for a while, but these levels often come before a pullback or just some sideways trading as the initial buying frenzy cools down. The price is now 15% above its 20-day moving average and a full 24% above its 200-day average. Think of another rubber band stretched pretty tight. Statistically, a mean reversion is likely since it needs to breathe. So, what this technical breakout does is it powerfully reinforces that fundamental story we talked about. The market has basically voted with its wallet, giving a big stamp of approval to the growth story, the profitability, and the fintech narrative. The quiet accumulation shows that institutions were already buying into this story before it became obvious to everyone else. This changes the character of the stock. It's not just another beaten-down name anymore. It's a growth story with proven momentum, and that will attract a whole new class of investors. So, looking forward, what are the key levels to watch? The new high around $6.06 is the immediate resistance to watch. If it breaks cleanly above that, it could keep running. but more likely we'll see a pullback. The first logical area for it to find support would be in the $5.50 to $5.66 zone. A healthy consolidation should hold above there. The most critical level, though, is around $5.30, which was a key support level before the breakout. If it were to break below that, that would be the first major red flag that this breakout might have failed. In conclusion, the technicals have caught up to the fundamentals in a really dramatic way. The long-term picture looks a lot better, but the immediate strategy should probably be one of patience. This isn't the time to chase the stock at these overbought levels. It's better to watch for a healthy consolidation or a small pullback to find a better entry point with a better risk to reward setup. Anyway, that's my take on it. I hope breaking down both the fundamentals and the technicals gives you a much clearer picture of what's happening with Grab. If you found this analysis helpful and you want more deep dives like this, do me a favor and hit that subscribe button. It really does help a new channel like this one out. Alright, that's all for today. DataCat out. Stay safe and stay sharp out there.